Heikin candlestick patterns, part 3. So this is the third part of a video series, and I'd encourage you to go ahead and watch this one. If you haven't watched the other two, no problem. You can watch these in any order. I will put the links to the other two down in the description below. So while you're here, watch this one first, then go watch the others. So Heikin bars, they smooth out price action, so they help you to stay into trades longer and not get out too soon. And that's what we focused on in the first two videos. Now, some questions came in from those two first videos and some really good ones. And I thought I better address those first, and then I'm going to go into this video on how to enter your trades. So the last two videos were using Heikin to exit your trades, so you don't get it out too soon, so you make maximum profits. This one is going to show you when to get into trades for a very, very, very high probability entry, so you really get stopped out. So let's jump right into it. All right, so one of the questions that came in was, hey, Barry, can you use Heikin bars for any time frame? And the answer is you can, but there are limitations. So great question, and I wanted to address that in this video. So they work really great with daily, weekly, monthly charts. Now, when you get into intraday charts, yes, you can still use them, but you need to be careful of one big thing. And actually, this could even occur on daily charts, and that is gaps. So here on the right, I've got a regular 2-minute chart of traditional Japanese candlestick patterns. And then over here, the 2-minute Heikin bars. So you'll see that the market opened this day with a big gap. But when you look over at the Heikin bars, you don't see a gap. There's no gap. There's just a big long red or a big green bar. And that's right. So Heikin bars will never print a gap. You will never see a gap on them. And that's because they incorporate two bars into one. So the bars here on Heikin, what would traditionally you would look at as the open, the close, the low, the high. Those are not the real open, low, close, high of price action, because what Heikin bars are kind of like an indicator. In the last video, I showed you the mathematical formula. You can check that out. And they take two bars and put them together. So because it's putting two bars together, you'll never see a gap. So you'll get these long green bars. So therefore, what do we make out of that? Well, this is a case where the Heikin bars, then I don't rely on them. Not every indicator, not every price pattern is to be used all the time. Sometimes we use them, sometimes they don't. Each tool in your trading toolbox has some strengths and some weaknesses. So it's very important to know when to use them, when not to use them, what their strengths are, and what their weaknesses are. So this is a weakness of Heikin. I do not use it with gaps. So that was the big question that came in. And as you can see, once it gaps up here, then any of this price action up here, any Heikin bars that form up here, I just totally disregard them. I'm not interested. I'm going to wait for price action to kind of get back to normal, and that gap might be filled, it might be a gap to go, whatever, but I'm going to let some time go by before I actually start looking at the Heikin patterns. Okay, so great question for the person who sent that in. Now let's get over to the second part of this video, which is how to use Heikin for entries. There are a couple of major criteria that you want to use for entries that are reliable. Now, a lot of people will just look at the bars turning from green to red and then say, okay, now we go short. And it's not quite that simple. It's not quite that binary. Just because the bars go from green to red or red to green does not mean you should now start trading in that direction. That's one thing. But then the other is the pattern on the bar. And that pattern is seen on this one. So what is that pattern? The pattern is that we have no wick on the top. Actually, we got no wick on the top on that one. So this one, we had a wick on the top and we had a wick on the bottom. So to go short, it's got to be, number one, a red bar. And number two, no wick on the top. It can have a wick on the bottom. That's fine. That's great. But no wick on the top. So for some people, that feels a little counterintuitive. It's like, wait, shouldn't there be a wick on the top? In a regular and traditional Japanese candlestick pattern, that would be true. A long wick on the top would be generally a bearish pattern. But on Heikin Ashi, it's the opposite. So a little counterintuitive there. But again, it's because it's a totally different formula, and it is not measuring, or it's not actually plotting the actual price action. So this bar, not a high probability entry. This bar is a high probability entry to go short, 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 short. All right. Now, another factor. So a third one. Number one, we got the color change. Number two, we've got no wick on the top for shorts. And by the way, it's the opposite for longs. And the other one is we want it to be near the swing high or for a long near the swing low. So this one's near a swing high, so that's great. But as we get further down here, I would not enter on, if this was the first bar that had no wick on the top, I would not enter on any of these bars. So it's got to be up here. We want to get in early on a new swing high or conversely along in a swing low. Therefore, when we look over here, well, yeah, this is a great example. Let me take these off of here. And let's go back and look at, let's stay short. Let's keep looking at our short examples. So here we go again from, even from here, green to red. Okay, we're not going to take that because why? There's a wick at the top. Same thing here, green to red. Not going to take it just because of the color change. No, there's a wick on the top. All these red bars, wicks on the top. So our first, and even this one, by the way, that one, if you look at it very carefully, it might not look like it, but yeah, there's a little wick on the top of the red real body. That is enough to keep you out. It has to have zero wick. Can't have any. And therefore, that is the first bar that we could actually go short on and have confidence. And sure enough, it does follow through to the downside. So you gotta wait for that. Otherwise, you can get into all this choppiness. And we don't want choppy market conditions. We want it just to, enter and take off. Now, as you might have noticed, not every cycle high and cycle low or swing high and swing low has this Heikin Ashi pattern, and that is true. So, just like I said before, each of our indicators and our price patterns, they come into use at some times, and they're very powerful. And we just wait until we get them. The rest of the time, we just don't worry about it. But if you want an indicator that will get you in more frequently than these Heikin Ashi entries, I've got one for you. And it's the indicator that I use for every single one of my trades. And it's what I use to enter every single one of my trades. So if you want to get that, I give it to all my viewers for free. You're a viewer, you get it for free. Just go to indicatorwebinar.com, check it out. It's a free recorded webinar, so you can watch it any time of day or night. And I give you the indicator there. I show you how to set up in your charts. And most importantly, I teach you how to trade it. So you become educated on how to trade it. So go check that out, and I'll see you on the inside.